Is Tata Technologies the next big thing in engineering, or is it dangerously overvalued? Here's what you need to know before you invest. Tata Technologies recently released its Q2 financials, showing a mix of growth and caution signals that have left investors divided. While the revenue numbers show promise, net profits have declined for a third consecutive quarter. In this video, we'll break down Tata Technologies' financial metrics, compare its valuation with industry peers, and assess the outlook for its stock. Is it worth the investment, or should we be cautious about its valuation? Let's dive in and look at the facts. Tata Technologies posted a modest 2% increase in revenue this quarter, reaching 130 crore rupees, despite facing challenges in the electric vehicle sector. However, the consolidated profit after tax declined by 2% year-over-year, down to 157 crore rupees. While this is the third consecutive quarterly drop in profit, it's worth noting that the rate of decline has slowed, indicating possible stabilization. Why the decline? Much of it comes down to the EV market slowdown, which has seen global demand soften due to high costs and limited charging infrastructure. This market downturn has had a direct impact on Tata Technologies, which has a stake in the electric vehicle sector through its engineering and software services. To get a better sense of Tata Technologies' position, let's compare its valuation with some industry competitors in the engineering services space. Right now, Tata Technologies has a price-to-earnings ratio, or PE ratio, of 66.2. This places it somewhere in the middle compared to its peers. For context, KPI Technologies has a PE ratio of 105, making Tata Technologies look more attractively priced in comparison. However, companies like L&T Technology Services and Tata Elxsi have PE ratios of 40 and 70, respectively, which suggests that Tata Technologies is still priced at a premium compared to some. Yet, Tata Technologies leads its peers in other critical metrics. Its revenue growth rate, or compound annual growth rate, CAGR, from FY21 to FY23 stands at 36%, notably higher than the 29% CAGR for KPI at L&T Technology and Tata Elxsi. Additionally, Tata Technologies boasts an impressive operating margin CAGR of 46%, showing efficient cost management and profitability, which outpaces KPIT's 43% and LT's 30%. In other words, Tata Technologies shows a balanced combination of strong growth and solid margins that investors find attractive. However, its PE ratio may signal caution for those focused on valuation metrics alone. Following the release of its Q2 report, Tata Technologies' share price experienced a slight dip, closing 1.23% lower, around 999 rupees and 50 paise on the Bombay Stock Exchange. Despite this small decline, investors aren't rushing to sell off. Instead, we're seeing a steady sentiment as they wait for a potentially stronger second half of the fiscal year, especially given the CEO's optimistic outlook for the months ahead. The CEO, Warren Harris, expressed confidence in the second half, expecting a better performance compared to H1. This sentiment aligns with recent sequential growth in Tata Technologies' services business and a solid order book for the coming quarters. Now, let's look at the positive sentiment driving some investors' confidence in Tata Technologies. Firstly, the company has impressive financial ratios that demonstrate operational efficiency. Its return on assets, or ROA, stands at a solid 25.31%, while its earnings per share, or EPS, is 16 rupees and 94 paise. These metrics highlight Tata Technologies' ability to manage assets effectively and generate profit, both of which are appealing to investors. Additionally, Tata Technologies' strategic focus on high-demand sectors like electric vehicles, aerospace, and defense positions it well for growth. The company's move into diversified sectors also helps mitigate risk from any single market downturn, such as the current EV challenges, and provides stability through varied revenue sources. This diversified growth approach, along with strong financial health, supports a positive outlook for Tata Technologies among growth-oriented investors. But not everyone is fully optimistic. Some investors express concerns, particularly around the company's relatively high valuation. At a PE ratio of 66.2, some see Tata Technologies as potentially overvalued in today's volatile market. Furthermore, the third consecutive drop in quarterly profit is raising questions about Tata Technologies' ability to sustain long-term growth, especially if EV market challenges persist. The slowdown in global EV sales could continue to impact revenue in the coming quarters. Additionally, broader market factors add to investor caution. Geopolitical tensions and market volatility may affect Tata Technologies' stock price, which some investors consider as part of their overall risk assessment. Overall, these concerns provide a counterbalance to the optimism surrounding Tata Technologies and reflect a careful approach by those with a value-oriented investment strategy. In summary, Tata Technologies offers a compelling mix of growth potential and operational efficiency, backed by a strong position in key sectors. While its valuation is on the higher side, its market position, growth rates, and profitability give it a solid foundation that many investors find attractive. Still, for those focused on valuation metrics and wary of market risks, the stock may raise a few red flags. So what's your take? Will Tata Technologies ride the wave of demand in engineering services and electric vehicles, or are the valuation and profit concerns too risky? Let us know in the comments below if you see Tata Technologies as a strong buy or a cautious hold. And if you found this analysis helpful, make sure to like this video, subscribe for more market insights, and follow us for the latest updates on Tata Technologies and the evolving EV market. Thanks for watching.